if someone wants to earn a couple of points, you might want to look into how many banks and branches have opened up in Nashville in the last in that area, in the Nashville area, the footprint in the last 5 years. Yes, ma'am. All right, Emily, do that. Okay, that's interesting. Okay, let's see. I know Mark Farley, when he was here, he got a PhD in finance, and he worked in banking, and his thesis had to do with how to determine if a rural area needed a new bank. That's what he wrote about. Man, boring. All right, so we heard Benet explain to us that why banks closed in 1988, 89, and then it happened again in 2007, 2009. Banks were busy shutting down, and they were busy, it's raining, and they were busy being purchased by other banks that had more capital. So if you had a strong capital position, 2007, 2008, 2009 was a great time for you. You were able to buy banks on the cheap. And the federal government was so concerned about the banking industry that if you wanted to buy, you got provisions and concessions from the federal government. They said, we will limit the amount of money you could possibly lose from bad loans and from bad securities. If you will buy this bank, instead of having us shut it down, then we will guarantee you that your losses, if there are any, will be limited to this level. So the downside is this, and the upside is unlimited. It was great if you were on that side. All right? Same thing as my buddy who bought his condo at the bottom of the market. But people who had to sell the condo, they were not happy. But he certainly was. And so if you had dry powder, what we call it, dry powder, then that was the time to buy. All right. Okay, so people have decided to branch instead of chartering. It's quicker and cheaper than chartering a new bank. All right, let's take a quick look. So anytime you start a new business, the risk is pretty high, the mortality rate is high. Okay? And typically what kills any new business is a lack of capital. A lack of capital. Okay? Not having enough capital. All right. So most banks do become profitable within 3 years. Okay? They often experience loan losses that are greater than average, but they do become profitable. And that question is on the exam. I remember seeing it. Okay? So the stockholders team, the board of directors, the management team are often the key to whether a new bank makes it. Okay? And I've seen this. You'll start, one of the things usually it's someone who wants to start a bank is experienced in banking. And they know other experienced people. And they will bring key people into the bank either to be stockholders, be on the board, or to be employees. So if you are a successful commercial lender at a bank, and this happened not too long ago, the guy who ran Simmons Bank, the market in Searcy and BB and a couple other towns, was personally responsible for a pretty decent sized portfolio of commercial loans. And he was stolen away by First Security. They knew that if he came over there, he could approach his Simmons customers and offer better terms, and they trusted him, and he moved a lot of that business over. So if you can handpick key people in the key departments, it's going to increase the likelihood that you're going to be successful. All right, let's see if we can get through 10. All right, so the failure rate, so the loan loss rate is higher at new banks. The failure rate is higher at new banks. Not surprising. Higher risk. They tend to underperform in terms of return on assets, return on equity. It takes them a while to ramp up. Their expenses are going to be a little bit higher. They've got to advertise more. People don't know them as well. People are going to be cautious in borrowing from them. Okay? It takes about 9 years to mature. So it takes about 3 years to become profitable and about 9 years to really mature. Okay? And the truth is, before that happens, most of these banks get purchased. Okay? All right. So a lot of these banks will be hit by the real estate crises that happen every 5 to 10 years, nationally and locally. And this is because the preponderance of bank lending, particularly with new banks, is into commercial real estate. Commercial real estate. And you know, for most cities, how do you measure whether the city is growing or not? And it's by the properties that are being developed. Okay? I remember when IHOP opened up in Searcy, oh, it was such a huge deal. It was hysterical. I've been living in Little Rock, and I've lived in Columbia, South Carolina, I've lived in Charleston, South Carolina, and these are all cities that are in the 300,000 to 400,000 range. You open up an IHOP in those cities, nobody even knows. But you open up a small strip center in a small town, man, it's a big deal. Big deal. They opened up Hobby Lobby and whatever over there off of South Main. You know, I mean, oh, it's a big deal. But if you're in a bigger city, you won't even notice that. Okay, so the banks get exposed to that commercial real estate. And so when the banks are new, the regulators are watching them more closely than they're watching the banks that have been around and that have proven that they know how to operate and comply. I think that's it. Oops. All right. That's it for the day. We'll finish this chapter on Tuesday, and I think that means that's 3 and 4, isn't it? I think that means another test. So here's the thing: if you want easier tests with less information to cover, which most of you do, then that means you're going to have more tests more frequently. No? You'd rather have 4 chapters? Okay. So both of these chapters were relatively short, and that's why we're taking a test now, and next week we'll end up taking another one. Peace out, shalom.